It is one of the most anticipated public offerings I have seen people talk about in years, and I understand why. Whenever a business reaches the point where ordinary investors start imagining what could happen if they get in early, you are not just looking at a company, you are looking at a story people want to belong to. SpaceX has become that kind of story. If you ask me why this matters so much, I would not start with hype. I would start with the longer arc behind it. For decades, governments around the world have been trying to move more of the space economy out of the public sector and into private hands. They have been changing rules, changing incentives, changing the way capital gets deployed, all with the same broad effect. They want private companies to build what tax dollars used to build. Inside that shift, SpaceX has become the most advanced and the most successful commercializer of space by a country mile. The launches, the services, Starlink, the broader infrastructure around it, all of that has put the company in a position where it effectively dominates the conversation. The valuation people are attaching to it is enormous, around $2 trillion. The amount it may actually raise is comparatively tiny that matters. When a company that large and that dominant finally opens the door, even a little, the market does not just see an IPO. It sees confirmation. It sees validation of an entire investment thesis. And that thesis is simple. If SpaceX is worth that kind of money, then the entire space complex around it may deserve a lot more attention, a lot more capital, and a lot more patience than most people have been willing to give it. That is the real attraction here. Most of the companies connected to this story are not pretending they can replace SpaceX. In many cases, they are building around it, launching through it, depending on it, or selling into the same broad expansion. I have said many times that once you understand where the toll road is, you stop asking whether every car on the road needs to be identical. SpaceX may be the dominant transport machine, but the businesses riding that build-out can still do very well. Now, one question I keep hearing is why the company has waited so long. The answer, as I see it, is straightforward. Elon Musk likes control, and control is always easiest to maintain when you do not need outside money badly enough to surrender terms. If a company is desperate for capital, lenders and shareholders start dictating the tempo. Musk has spent years trying to avoid that. That is why I have always thought the profitability issue mattered more than the timetable people were gossiping about. The core SpaceX business itself may still not be the easiest thing in the world to value cleanly, but Starlink changes the whole posture. Starlink gives the company a serious revenue and earnings engine. It gives it breathing room. It means the company can approach the market because it wants the capital, not because it cannot survive without it. That is a very different negotiating position. As for getting exposure before the IPO, most investors are not going to buy SpaceX itself on some convenient exchange screen. The secondary market exists, yes, but it is risky, constrained, and generally geared toward accredited investors with serious capital. So for most people, the practical routes have been indirect exposure. Businesses with early stakes, businesses tied operationally to the launch ecosystem, businesses that may benefit when more institutional money starts flowing into the sector. That brings me to timing. The expectation here is that the listing process is moving through confidential channels, which is exactly what you would expect from a company trying to avoid unnecessary turbulence before it is ready. The working assumption is a mid-year window, potentially June, maybe slightly after. The exact date matters less to me than the behavior likely around it. If this thing prices, I would expect very heavy demand. I would expect oversubscription. I would expect a lot of volatility. I would also expect the sort of emotional behavior you always get when people fall in love with a symbol before they have spent much time on the economics. That is why I do not think the smartest posture is blind urgency. If you feel compelled to buy the IPO the moment it appears, fine, that is your decision. but do not confuse excitement with discipline. A heavily anticipated offering can spike, reverse, overshoot, and shake out weak holders in a hurry. If I were handling this with my own money, I would want room to be patient. I would want reserve capital. I would want to know that if the market turns the first few weeks into a circus, I am not forced into bad behavior. But the more interesting question to me is not whether you should chase SpaceX itself. The more interesting question is which businesses may benefit before or alongside that event. The first one I would look at is Rocket Lab. If SpaceX is the overwhelming leader in domestic space launches, Rocket Lab is the next most credible operator in that lane. A distant second, yes. But second still matters in a market that is growing, commercializing, and demanding more launch cadence. What stands out here is not fantasy. It is pace. The company is increasing its launches. It is commercializing its vehicle. It is broadening its operational footprint. And when I look at businesses in speculative sectors, one thing matters more than all the noise people throw around online. I want to know whether the revenue engine is becoming more real or less real. In Rocket Lab's case, it is becoming more real. Revenue exists today. It is not some purely theoretical line item. It has been growing at a healthy pace, and the path toward profitability is now close enough that investors can actually start underwriting it rather than merely dreaming about it. In a market like this one, where people have become much more sensitive to cash flow and actual earnings, that matters more than it did a couple of years ago. There is also a bigger layer under the surface here. For years, a lot of demand has centered on launches themselves and satellite constellations going into orbit. That is still important, but it is not the whole story anymore. The next layer is infrastructure in low orbit, medium orbit, and eventually the moon. Once the conversation shifts from isolated launches to sustained activity and sustained infrastructure, the companies with established launch capabilities start to look a lot more strategically valuable. And then you come to the moon. A lot of people like to talk about Mars because it sounds grander. But before Mars, there is the moon. Before a dramatic frontier narrative, there is the practical step of building something closer, more permanent, and more commercially useful. If that progression continues, Rocket Lab stands to benefit because its services fit the build-out that comes before the fantasy fully arrives. Now, people will point at the stock chart and say it has already had a major run and a serious tumble. That is true. But when I look at a chart, I do not ask whether the stock was once higher. I ask whether the underlying outlook improved enough to justify the market building a new support level at a higher price than before. That is what seems to be happening here. The surges came because the fundamental picture improved. The pullback came because markets always overshoot, digest, and reset. If the market is now supporting the stock at a higher plateau, that tells you something useful. It tells you the long-term ratchet may still be pointing upward. The second name is AST Spacemobile. This one is a different kind of story because the concept is easier for ordinary people to understand immediately. A world where your phone keeps working in places where it should not. That gets attention because the value proposition is intuitive. People do not need a long lecture to understand why uninterrupted coverage matters. The temptation, of course, is to stop there and fall in love with the idea. I try not to do that. An idea is not a business. A concept is not a return. But if I strip this down to what matters, the company is doing more than selling a dream. It is ramping launches. It is putting the constellation into space. It is expanding service capacity. Revenue is beginning now, not in some distant science fiction chapter. And the expectation is that profitability could arrive within roughly 2 years. That is important. You can forgive a lot of current losses if they are financing a build-out where the eventual revenue streams are large, visible, and supported by real contracts. The reason the market keeps giving this stock oxygen is that the technology appears to work. The major counterparties are there, and the execution path is narrowing from pure speculation toward operational reality. That does not mean the risk is gone. It means the risk is changing shape. The biggest risk here, as I see it, is execution. Delays, slippage, timelines extending in ways that damage the market's confidence. A business like this can get punished very quickly if the calendar starts moving faster than the infrastructure. But if execution remains intact, I can understand why the market keeps bidding the shares higher in waves, pulling back, and then trying again. And once again, there is the familiar issue you see across this whole sector. Heavy cash burn, large capital needs. People get nervous when they see it, and rightly so. But there is a difference between debt that is funding desperation and debt that is funding capacity into already visible demand. In an industry build-out, those are not the same thing. If the backlog and the commercial relationships are real, then the temporary financial strain can be part of building the machine rather than a sign. The machine will fail. The third stock is Intuitive Machines. This is where the moon story gets more direct. They are not the launch giant. They are not trying to become the all-purpose rocket empire. They are more focused on robots, landers, and the kinds of components and services that become relevant when activity in and around the moon stops being ceremonial and starts becoming repeatable. That niche matters. One reason I like this story more than some of the louder ones is that the revenue profile has already become more substantial than many people realize relative to a lot of the non-SpaceX names, the top. Line growth is strong, and the path to profitability is closer than in much of the sector. In a field full of businesses burning cash on distant possibilities, a company moving toward profits next year deserves a closer look. What also matters is that not all of the money comes from one glamorous line item. Yes, the lunar landers are the exciting headline, but the actual business also includes services and engineering work tied to NASA and government, related contracts that broadens the foundation. It means the company is not simply waiting for one moonshot to justify its existence. It is earning its way through related work while preserving exposure to the larger lunar build-out. That is a healthier position than many people think. If SpaceX and the broader ecosystem keep pushing the moon from aspiration toward infrastructure, businesses like this can become much more central than they look at first glance. That is the attraction. The stock has already shown it can move violently on good news. And I do not dismiss that risk. Sharp advances can always reverse, but I understand why investors are starting to treat profitability here as a meaningful catalyst rather than a vague hope. The fourth name is Planet Labs. This one sits in a different part of the space economy, Earth imaging rather than lunar transport or cellular coverage. It is a reminder that once people hear space, they often imagine only rockets and astronauts, when in reality a lot of the business case is data, images, monitoring, and information flowing back down to Earth. Planet Labs is still early relative to where investors eventually want it to be. It has launches, it has a constellation, it has revenue, but profitability remains further out. The runway to real earnings is longer here than in some of the other names on the list. On that basis alone, I understand why some investors hesitate. But the chart and the ownership trends are not trivial. The market appears to like the direction of the story. Institutional ownership is meaningful. Buying activity from those institutions has reportedly been stronger than selling. That matters because the companies with longer runways often need a different kind of shareholder base. If impatient capital owns the whole thing, the stock gets jerked around by every quarter. If more durable capital starts building positions, the business gets time to develop into its economic promise. The connection to SpaceX here is not mystical. It is operational. Planet Labs uses the launch infrastructure that SpaceX provides. In that sense, a broader acceleration of space investment, especially after a major IPO that legitimizes the whole sector in institutional minds, can help names like Planet Labs simply because more attention, more capital, and more ecosystem spending tend to raise the tide around supporting businesses too. Would I say this is the clearest, strongest story on the list? No, but I would say that when a market starts rewarding a company despite its longer path to profits, I pay attention. Sometimes that means the market is wrong. Sometimes it means the market sees momentum in the business that the accounting has not fully translated into earnings yet. You have to decide which side of that line this one sits on, but I can see why it is on the watch list. The fifth stock is Redwire. This is perhaps the weakest looking chart of the bunch, and I want to be honest about that. A lot of people only want to hear a story if it is clean and triumphant. Markets are not that polite. Redwire is more tied to orbital manufacturing and the underlying infrastructure that would support a more active space economy. Think less about the glamorous launch and more about the structural pieces that make activity in orbit more functional. Solar arrays, support systems, the hardware that makes larger operations possible, that gives the company strategic relevance. If the space economy keeps expanding, the issue is timing. Like Planet Labs, this is a business where profitability still sits further out. The stock has struggled, and the chart reflects that. It does not look as forceful as some of the others. If you were ranking these purely on immediate visual momentum, it would not be at the top. But this is where investors get tested. Sometimes the best-looking chart is not the best long-term setup, and sometimes the least loved chart sits closest to the bottom when the broader sector is about to get a new wall of capital and attention. If space investment accelerates in a serious way, businesses tied to manufacturing capacity, infrastructure build-out, and support products can become more relevant very quickly. That is the case for owning something like this before the crowd fully decides it matters. In the near term, there may still be headwinds. I do not dismiss that. But if the sector as a whole enters a stronger phase, Redwire at least has a reason to be in the conversation. Now, when I look across all 5 names, I see the same pattern repeating in different forms. Rocket Lab offers a more established launch story with revenue and approaching profitability. AST SpaceMobile offers a highly intuitive concept with real execution milestones that are steadily removing the dream discount. Intuitive Machines gives you one of the more direct linked operational stories with profits coming into view sooner than many peers. Planet Labs gives you Earth, side utility within the broader space infrastructure build-out. Redwire gives you leverage to the less glamorous but still necessary layer of orbital manufacturing and structural expansion. And all of them sit under the same bigger banner. Space is moving from spectacle to industry. That is what the SpaceX IPO really threatens to confirm. I do not mean threaten in a negative sense. I mean it threatens to remove the comfortable skepticism that has allowed many investors to ignore the sector. Once a dominant player goes public at a gigantic valuation, a lot of people who were content to watch from a distance start doing math very quickly. They start asking which suppliers, which adjacent operators, which launch partners, which niche specialists are still early enough to matter. That is why this moment deserves attention. Not blind enthusiasm, not reckless buying. Attention. I would still tell anyone looking at this group to stay disciplined. This is not a group of sleepy consumer staples. There will be volatility, there will be surges, pullbacks, broken hearts, repaired hearts, and more than a few quarters where the market gets excited too early or loses patience too fast. That is normal in an emerging build-out. But I would also say this, if you believe that the privatization and commercialization of space continues over the next decade, then waiting for the SpaceX IPO alone may be too narrow a frame. By the time the headline becomes obvious to everyone, some of the easier money may already have moved. The better question is, which businesses are already building something real while the market is still arguing over whether the broader thesis deserves to be taken seriously? That is the question I would ask. And if I were looking across this list with that in mind, I would not be staring only at the IPO date. I would be watching revenue growth, watching the path to profitability, watching backlog, watching who is commercializing real services, and watching which stock prices are establishing support at meaningfully higher levels despite all the usual macro noise, because that is how major themes tend to play out. They look speculative for a long time, then they look inevitable. And by the time the second phase arrives, the patient people who studied the first phase are already in position.